Hi guys, my name is Nana and you're welcome to the channel once again. So in today's video, we'll be discussing actionable tips on how to realize the greatest gains from the stock market and invest just like Warren Buffett, the world's most successful investor of all time. So without further ado, I'll share with you 8 critical things that you need to know before going on to invest your hard-earned money in the stock market. Warren Edward Buffett was born on 30th August 1930. He is an American investor and philanthropist who currently serves as the CEO and chairman of Berkshire Hathaway. As a result of his investment success, Buffett is one of the best-known investors in the world. As of October 2024, he had a net worth of $147 billion, making him the 8th richest person in the world. Buffett was born in Omaha, Nebraska, the son of the U.S. congressman and businessman Howard Buffett. He developed an interest in business and investing during his youth. He entered the Wharton School of the University of Pennsylvania in 1947 before graduating finally from the university at age 20. He went on to graduate from Columbia Business School, where he molded his investment philosophy around the concept of value investing, pioneered mainly by his mentor, Benjamin Graham. So firstly, the first thing that we need to consider when it comes to investment, according to Warren Buffett, is that you need to put your money only in businesses that you understand.
And can you tell what's in that box and what isn't in that box? And that's what I call knowing your circle of competence.
So for example, when you take a critical look at his portfolio, you can see companies like Coca-Cola, NU Holdings, and then several other companies he is very, very comfortable with. And these are companies that he's gained experience, or industries that he's gained experience in over the years. So what he actually goes on to advise is that you may have a certain niche or a certain industry that you've got expertise on. It might be the medical field, it can be in agriculture, it can be in the economy, it can be in the finance or insurance industry, where he also invests. But then just make sure that you're making the right decisions. You're picking stock or choosing companies that fall within your area of expertise. By so doing, it makes it very easier for you to pick the right stocks and then over the long run, maximize your returns in the stock market. Secondly, Warren Buffett advises that we need to look out for companies with a very, very huge competitive moat around them. So a moat is simply something that gives another company the competitive edge over its competitors. So for example, for Coca-Cola, it might be its supply chain, or it might be the number of companies or depots out there that it gets to supply to, or it might be the quality of the management that they've got. The competitive mode can come in several forms. It might even be in the form of their access, or how easy they access capital on the stock market. So what Warren Buffett actually looks out for is a company that has got all these things at their disposal. By so doing, it becomes very easy for them to roll out new policies, new programs, new operation lines. It becomes easier for them to access capital and then expand over the years. So whenever you're going on there to pick a stock in the stock market, instead of actually looking at just the prices of the stock like many people out here do, you need to go beyond that, lift the veil, and then look out for all these competitive advantages that these companies have. A company, for example, like Apple, has got a brand moat around it. Several people out there would choose Apple iPhone or Apple products over other companies simply because they want to look good, or they want to have or secure a perception from society. That is exactly what Warren Buffett goes in there. And that is why he eventually bought Apple shares and then went on to secure Coca-Cola shares as well. So going out there, you need to look out for companies that have got all these competitive advantages that positions them in the very long run to gain more revenue and then ensure growth. Thirdly, Warren Buffett invests for the long time.
I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them.
He is noted to have said that the best holding period for his investment is forever. So he doesn't seek, or he doesn't intend to purchase stock and then trade them off or sell them over the shortest possible time. Instead, he holds on to these stock, make sure that they realize or grow over time, and then eventually he reinvests all the dividends back into these stock. He builds a huge portfolio and then they pay them back over time. What Warren Buffett advises is that you hold on to the stock that you pick, and by so doing, over time, the stocks, whether they are trading at below their market value or above their market value, would correct and then realize huge potential and huge returns for you. So whether the prices of the stock are fair on the stock market or whether they are trading below stock market, you don't have to worry about it, because you believe that once you hold them for a very long time, they will correct themselves, the real prices would reflect over time, and then eventually you'd get to secure the returns that you actually went on to pursue by investing in these companies. The fourth advice that Warren Buffett actually sends out to us is that we need to find undervalued stocks, purchase them, and then wait over time to make sure that the market corrects them or their values actually go up on the stock market before trading them and then realizing returns. So there are several other measures that you can use to determine whether a stock is undervalued, overvalued, or fairly priced. One of such methods is a discounted cash flow method, or the price to book ratio, or the price to earnings ratio. These actually are technical terms or quite technical tools that the analysts use to determine whether or not stock prices are fairly priced or overvalued or undervalued. But like I've said, you don't have to do everything on yourself. There is a need for you to consult when there's a need, because mind you, you don't want to lose your hard-earned money. So if it takes a couple of consulting to be able to make the right choices on the stock market, for example, by paying experts to determine what stocks are likely undervalued so that you can purchase them, wait, hold on them, and then make sure that they realize their gains over the stock market, and eventually you realize your returns as well. There's nothing wrong with going to experts and then asking for advice when it comes to investing your hard-earned money. Because think about it, the first rule of Warren Buffett is to never lose money. If you never want to lose money, there's a need for you to do the due diligence when going out here to pick stocks on the stock market.
First rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
Now, the fifth advice that we want to consider from Warren Buffett is that you also need to look beyond just the stock prices and then look at the quality of management that the companies have. For example, he's noted to have said that his late partner, Charlie Munger, and him are not stock pickers, i.e., they don't pick stocks. Instead, they pick businesses. They choose companies and not stocks. Insofar as stocks are a chunk or a minute portions of companies, so what you want to do is that you want to look at the quality of management, and you can ascertain these through their annual publications or annual management disclosures and analysis, or you can even assess it through the company's financials at the end of the year. There are several news agencies out there that break these things down to make it easier for you to know whether or not you can trust the management of a particular company before going on to patronize their stock on the stock market. The sixth point that we want to consider is that you've got to reinvest your dividends or reinvest your returns in order to realize the power of compound interest.
Einstein is reputed to have said that compound interest is the eighth wonder of the world or something like that. And it goes back to that story you probably learned when you were in grade school where somebody did something for the king and the king said, "What can I do for you?" And he said, "Well, let's take a chessboard and put one kernel of wheat on the first square and then double it on the second and double it on the third." And the king readily agreed to it. And by the time he figured out what 2 to the 64th amounted to, he was giving away the entire kingdom. So it's a pretty simple concept, but over time, it accomplishes extraordinary things.
So Warren Buffett believes strongly that in order for you to realize the massive gains on the stock market, you don't have to touch anything or the proceeds from your investment. You need to try as much as possible to reinvest all your gains back into the stock market. By so doing, the power of compound interest would eventually just try as much as possible to skyrocket your gains by way of increasing the number of shares you hold. Because once you go on to reinvest your residual profit or your dividend into the stock market, it leads you to become more and more sound over time, because the number of shares that you hold, mind you, will determine the amount of dividend that you receive. So over time, just try as much as possible not to sell or to trade these stocks off. Mind you, we are holding these stocks forever, just as Warren Buffett does. He purchased Coca-Cola several decades ago. Until now, he still holds on to these stocks because he knows that eventually the power of compound interest would pay him back and then ensure that his initial capital that he invested is actually offsetted and he's gone on to make huge gains in the stock market. Lastly, I think the most important thing out of all this is that you need to constantly educate yourself.
So I encourage everybody to build your own moat around yourself.
On the stock market, you need to read books that helps you to understand how companies operate, to help you understand the operations of company, to help you assess whether a company's management is worthy of your trust. By so doing, it puts you in a better position to be able to go on and then determine which companies are worthy of your hard-earned money and how you can go on there to invest wisely, or which stocks, investment options, or investment funds are worthy of your hard-earned money. Or you can also go on to ascertain whether or not it is worthy for you to invest at a given particular point in time. So by so doing, no expert out there can come and then dupe you and say, if you put X amount of money here, you realize Y amount of gains. You know what you're doing, you've educated yourself, and then it's become much more easier over time because you consistently stay updated or abreast with issues in the stock market and with the companies. So there you have it. These are the most essential tips or the essential advice that you need to consider when it comes to investing in the stock market. There are several people out there that will promise you several gains, promise you about how to teach you to realize X amount of money on the stock market. All these people are selling you courses that may likely in the long run lead you into losing your hard-earned money. What you want to do is to follow the time-tested principles of people like Warren Buffett, and patience in the long run will pay you off for every single decision that you make. You need to try as much as possible and educate yourself before going out there to follow the dictates of people that pretend to be experts in the stock market, and then eventually they sell courses and then make money off your back. Thank you.